So there's three magic numbers when it comes, from my perspective, when it comes to investing. The numbers are 10, 6, and 3. 10 is the past 100-year average return for S&P 500 for U.S. large cap stocks. 6 is the same return for similar types of companies, because you didn't always have the same exact ones, but aren't apples to apples, bonds in those companies instead of stocks, 6%. And then 3 is inflation. So now if you take the 10 for stocks and subtract out inflation, it's 7. If you take the 6 for bonds and subtract out inflation, it's 3. The bottom line is we all need a lot more 7s than 3s if we're going to make it in terms of preserving and growing our wealth. From the 1960 to today, when the S&P has gone from 60 to 5,400, what also happened is the S&P 500 has done something 3 times. Then it only normally does 1 or so in 100 years, according to Charlie Munger, which is go down to half. And it did it in 73.4 in 2002. And then only 6 years later, in 08 and 09, went down to 60%. So that happened. That was 3 times in half, including those 3 halvings since 1960. You had about 13 or 14 bear markets, down at least 20%. In addition to those 3 halvings, you also had something like 10 recessions, and you've had almost an equal number of Republican and Democratic presidents. You've had war and peace. You had the Cuban Missile Crisis, where it could be blown up 90 miles off the shores of Cuba by Russia, and people were changing their life plans because of that. And you can go on and on. So with all of that, the S&P made 10.25%, 10.5% a year for that period. And what did someone have to do to garner those returns as an investor? The single most important thing they had to do, unfortunately, is also the hardest thing for them to do.
Yeah, do nothing, right?
Nothing.
Yeah.
That's it. If you've ever been on the highway and see, you may drive like this, I don't call them a lunatic, but you ever see that person, go weaving in and out of lane. What they need to realize is the average lane speed is the same. The person who doesn't weave gets to this endpoint almost always the same time they do.
Yes.
They jeopardize their chances of getting there because they're going to get into an accident. Same thing in investing with performance chasers. Your average returns are going to be what they are over multi-decades. You're not going to outsmart the markets and the indexes.
Yeah.
You may some from time to time, but you have a chance of blowing yourself up. You're like that driver. So the action bias causes us to do a lot of bad things. And in investing, I always say, it's not, don't just stand there, do something. It's the opposite. Don't just do something, stand there in response to the tariffs, to the pandemic shutdown, to the Japanese bubble bursting, whatever it is. Just keep diversified, let it compound, rebalance. Just don't do anything to change your plan in response to whatever it is you're afraid of. Feel the fear. It's normal. I'm telling you that. Just don't reflect the fear by changing your long-term portfolio strategy. You still need the more 7s than 3s, no matter what's going on currently.